Good evening, everyone. I welcome you all in this today webinar series on tax audit practice session 10. So today we are having panel discussion on issue in tax audit, and we are very lucky to have 4 speakers with us: CA Jayaprakash Falorji, CA Manohar Ayalare, CA Sachin Bansalji, and CA Atul Doshi. And also we have with us our session moderator, CA Pratish Munotji. So my dear fellow colleagues, I welcome you all in this 10th session on the series of webinar on tax audit. As you all aware that TAQRB bring out this series of webinar in helping and guiding the members for enhancing and improving the quality of tax audit. In today's session, we would highlight some of the typical issue that we have faced during the tax audit and the way to address these. Now, without any further delay, I would like to invite CA Pritesh Munotji, our session moderator, to take over the session. Pritesh,
Thank you. Yes, thank you, CA Raj Chawla, sir, Chairman of the TAQRB. Thank you for giving me an opportunity. Myself, CA Pritesh Munot, I am a management committee member of the Pune branch. I welcome you all for this today's session, number 10. And today we are going to have a panel discussion on issues in tax audit. And for the same, we have 4 speakers with us. I welcome everyone and all the participants who have joined for this session. I welcome today's speakers, CA Jayaprakash Falorji, CA Manohar Ayalare, CA Sachin Bansal, and CA Atul Doshi. So before we start our session, I would like to introduce all our today's speakers. First, I'll introduce CA Jayaprakash Falorji, sir. He was a founder chairman of Nanded branch of ICI, past president of Nanded Chartered Accountants Association, past secretary of the Nanded Income and Sales Tax Practitioner Association. He's been twice co-opted member for the WISC. He's practicing since 1989, and he's working in various fields like income tax, GST, VAT, DIC, NABARD, and as well as the bank audits. He's been speaker with the various seminars at branch level and at other levels. He's also a technical director of Nanded Merchant Cooperative Bank Limited, Nanded. Welcome, CA Jayaprakash Falorji, sir. Our today's second panelist is CA Manohar Ayalare, sir. He's a partner in Manohar Ayalare and Company. He was also a past chairman of Nanded branch of WIC of ICI, founder chairman of Nanded branch of ICASA, former president of the Tax Practitioners Association. He's also served as a secretary of Nanded CA Association. He has experience in statutory bank branch audits, tax audit of trading concerns, cooperative banks, sugar factory. He also has the experience in internal audits of private limited companies, also concurrent audit of various banks. He has worked as a visiting faculties in many colleges and given lectures and seminars at the branch level and other ICA platforms. So welcome you, sir.
Thank you.
Yes. Our today's third speaker is CA Sachin Ramnivas Bansal, sir. He is FCA, MCOM, MBA, LLB research scholar. He is practicing since last 25 years. His specialized area are GST, income tax, audit and consultancy. He's partner in AGH and Associates, and this firm is working since 1995. He has, with this all the degrees, he has some more certificates in his feather. He has completed certificate course in cooperative audit, certificate course on GST, certificate course on forensic audit, then certificate course on cyber laws, then certificate course on contact training from Johns Hopkins University, USA. He is currently chairman of Pimpri-Chinchwad branch of WIC of ICI. In social service, he is the president of Agrawal Samaj, Aund Road, and also the trustee of Srimati MC Bansal Charitable Trust. I welcome you, sir, Sachin Bansal, sir. Our fourth panelist,
Thank you.
CA Atul Doshi, sir. CA Atul Doshi, sir. He is a member from 1998, BCom, FCA. He has completed his visa as well. And he has completed many certificate courses like certificate courses in international taxation, arbitration, bank concurrent audits, ALM. He is a past chairman of Satara branch, convener of study circle. He is also a director in one of the cooperative bank. He is a trustee of Mandhardev Trust. He is also a vice chairman for Nagar Vachanlal Satara. So I welcome you, C. Atul Doshi, sir.
Thank you.
I welcome everyone for this panel discussion. This session will keep it a little friendly. I'll ask some questions which have been received from all the members, and this session will be, it should be very interactive in that way. So some questions I have gathered, which I'll ask one by one. So I hope you all speakers are ready. So shall we start the panel discussion?
Yes.
Yes, we can
Okay.
start.
Thank you. So the questions which I've received, so I'll start from some of the basic things. So to start with the basic thing, I just want to ask a question on clause 22. So what are the steps to be taken by the tax auditor while reporting under clause 22? CA Sachin Bansal, sir.
Hello, everyone. Good evening to all of you. And I like to thank TAQRB for giving me this opportunity to be a panelist on this session 10 on issues in tax audit. So thank you, CA Dr. Raj Chawla, sir, and CA Dr. Chandrasekhar Chitle, sir, in absentia. And my co-panelist, I also recognize them, CA Jaiprakash Falor, CA Atul Doshi, and CA Manor Ailane, and the moderator, CA Pritesh Mohan. Thank you all. So coming to the subject proper, when we are reporting in TOS 22, so it is about the Micro, Small and Medium Enterprises Act 2006. So we have to gather the information with respect to the interest paid to the persons who are registered under MSME. So the auditor should seek information regarding the status of the enterprise, like whether it is covered under the MSME Act or no, and whether where the information has been available and it has been disclosed. So same should be reported as such in Form 3CD. But where the information is not available, the auditor should also mention that it is not available and it should report in the Form 3CD. The next step is that since Section 22 of the MSMED Act requires disclosure of information, the tax auditor should cross-check the disclosure made in the financial statements. So whether in the financial statements they have shown the interest to be paid to the MSME, and they should cross-check what are the disclosure made in the financial statement. Similarly, again, going ahead, the auditor should obtain a full list of suppliers of the SSE, which fall within the purview of the definition of supplier under the section 2 into bracket N of the MSME Act. Again, here I have to clarify that it is a responsibility of the auditee to classify and identify those suppliers who are covered by this Act. So the auditee should provide the list of persons who are covered under the Act and give it to the auditor. After the list is obtained, the list should be reviewed by the tax auditor. Then the next step is that we have to verify the books of accounts, whether any interest payable or paid to the buyer in terms of Section 16 of MSME Act has been debited or provided for in the books of accounts. So if the interest is debited or it is provided, then only we can comment on this section, clause 22. Then the next step is that we have to verify whether whatever interest that has been shown as payable or paid is correct, and on test check basis we have to verify that whether it is matching with the interest as per the MSME Act. Then we should also verify the additional information provided by the auditee relating to the interest under section 16 in his financial statement. So that 45 days thing is there, whether he has paid within 45 days, all that additional information you have to verify. Then lastly, if on test check basis the auditor is satisfied, the amounts debited to the profit and loss account should be reported under clause 22. So here we have to just report under clause 22 how much is the interest paid as per the MSME Act. So all this verification after we have satisfied, then we have to report the amount of the interest. That is the steps that we have to take while reporting under this clause 22. Thank you.
Okay, thank you, Sachin sir. The next question is for PM Manohar sir. If losses happen at asset and that is on the book value, and the insurance claim is less than the book value, so in that scenario, what would be our stand? So how
Okay.
reporting should
Hello,
be?
everyone.
Yes.
Good evening. I'm thankful to the TAQRB for giving me this opportunity. I'm also recognize all panel speakers, CA Sachin sir, Hello sir, Atul bhai, CA Ritesh ji. Actually, loss of asset, if we claim loss, it is actually credited to the asset, and receivable is shown in the balance sheet. When the insurance company gives us a claim, if it is less than the amount which has been claimed as loss, or we have debited to claim receivable account, then in that case, the amount such received less from the insurance company needs to be debited to profit and loss account. Actually, this point is not a part of section 41 into bracket 4. Actually, section 41 into bracket 41 requires that if any liability or any loss which has been debited earlier, and now if the SEC received anything on that account, that needs to be reported. Thank you.
Okay, thank you, sir. Next question is to CA Jayaprakash sir. If the GST refund is due and received, but in the balance sheet it was shown as a GST receivable, then which amount is to be reported as per clause 16 of form 3CD, whether the whole amount or the difference?
Hello everyone. Thank you TQRB for inviting me as an analyst for the tax audit seminar. I'm thankful to Raj Chawla sir, sir, for giving me this opportunity. As far as this question goes, that whenever a refund is received from a GST or it's due, if it is received, then it comes into the books of accounts. If it is not received, then definitely we have to take a representation from the SSE that the refund is admitted by the respective authorities and it has not been received. Whenever such things comes in the books of accounts, then only we are supposed to get that information. Otherwise, whatever is due is not.
Sir, I guess, sorry to interrupt, sir, but
Yeah.
I guess your voice is not getting clearly. Am I correct? All other speakers is the same thing?
Yes, it is.
Yeah.
Clear,
Yeah,
sir?
there is some disturbance.
There is some
Some
disturbance in your
disturbance.
voice. We are not
Yes,
able
it
to
is
hear
clear,
you
sir.
properly, sir.
It is now clear, sir?
Yeah, it is clear, but I guess the fan is on and that air is passing through, and that's why your voice is not audible clearly.
Clear, sir. Now?
Yes, yes, now we are getting clear.
Yeah. Shall I start from the, shall I take it?
Yes, sorry, sir, but please.
Okay. Thank you.
Yes, yeah.
The question was, when a GST or any refund or a refund pro forma duty drawback is received by the SSC and it is recorded in the books of accounts, then fine. The excess amount, whatever you have received, is that has to be shown in the particulars you are required to be submitted in clause B of in clause B 28 point clause 15 and clause B. The question is, when it is due and admitted, the clause which requires us to mention is due and admitted by the authorities. Since those entries which are not come into the books of accounts, we are unable to certify anything based on that. For this, we should take a representation from the management that these are the dues which have been admitted by the respective authorities, but we have not received till date. That can be reported. If certain things they are already been accounted due, if a particular GST amount is already receivable as shown in the books of accounts, then whatever over and above that amount has been received, we have to report that amount, or a reference could be made that we have received a refund of rupees so and so. Reference to the clause is most mandatory. Particularly, this is also subject to condition that method of accounting they are following. If you are following cash system of accounting, definitely it will not have an impact, since we are recognizing the revenue based on the receipt of the money. So method of accounting is also important, but reporting under this clause has to be there, subject to a condition that we are following cash system of accounting, and therefore it has not been credited to profit and loss account. Thank you, sir.
Okay. Thank you, sir. Yes. Now the next question is to Atul, sir. If in case of company, there is a loan or deposit and which is repayable on demand. So whether it is to be reported under the clause 31C or how it is.
Good evening, everyone. And first, I thank you to TAQRB for the giving the opportunity to share some of the knowledge we have. And I also thanks co-speakers with me, Manohar and Parlor sir and Sachin Bansalji and Manojji to coordinating this program. As far as your question is concerned regarding that loan or deposit, see, if you go to the Companies Act, the Companies Act gives a stipulated time in which you can repay the either loan or deposit. That's why that has to be some time limit has to be there for the loan or deposits as far as Company Act is concerned. So in that case, if the money has been received and that is repayable on demand, that is not covered by the Companies Act as a loan or deposit. That's why the clause 31C should not be applied in that case, as against in non-corporate assessees. This will have different issues. In that case, this you will have to report under clause 31C, and that has been confirmed with the guidance note issued by the ICI. Even the draft guidance notes 23-24 also says like that, and earlier guidance note also says like that. Thank you very much.
Thank you, Atul, sir. The next question to Sachin, sir. What would be the disallowance in case the auditor is liable to pay any interest under MSME Act, but he has not provided that interest in his books of accounts? So
Yeah.
what would be the remedy?
In such a case,
For
there
this.
can be no disallowance. Because see, the disallowance is when you have claimed the interest in the books of accounts. If he has not provided the interest in his accounts, although he is liable to pay the interest, then there can be no disallowance as such. But whenever that person pays the interest and claims such interest, the same will be disallowable in the year of payment, because he has not followed the MSME Act. So therefore, if he has not provided, then that year it will not be disallowed, but it will be disallowed when he pays and claims such interest in the next year or whenever he pays it. And in case the auditee has adopted the mercantile system of accounting, the non-provision may affect the true and fair view, and auditor should give suitable qualification saying that although he is following the mercantile system, he has not provided for the interest. So such non-provision is not in line with the true and fair view, and the auditor should qualify accordingly. Thank you.
Okay, great, Sachin. The next question is to Manoj, sir. In case the assessee has given the denial to pay the debt, or that debt is has been time barred. So in that case, what would be the treatment in the tax audit report and books of accounts?
See, our institute's guidance note provides guidance about this. the auditor needs to report all this under clause 25 of Form 3CD, and section 41(1) deals with all these conditions. If there is a outstanding liability in anyone's books, and if he shows it as a liability, see, it is if it is long outstanding, say for 3-4 years, it is showing as a liability, but he might have verbally denied the payment of liability. Such case came before the Bombay High Court in the matter of CIT versus Chase Bright Steels Limited. The High Court given the decision that the denial can't be on record, but if the SEC is showing the same as liability in his books, that is sufficient proof that the same need not be considered as remission or cessation of liability. And in that particular case, section 41(1) doesn't apply. That's why if the concerned person is showing liability and it is still outstanding for say 3-4 years or longer period, but if he is recognizing that as liability, and as far as he is recognizing the same as liability, question of application of section 41 doesn't arise. The auditor needs to verify all the things, and auditor can't go beyond books. He can't know the denial. So if it is in books, then in that particular case, the liability doesn't come under 41(1). That need not be added as income. Thank you.
Okay, great, sir. Next question is to Jayaprakash, sir. In clause 16, there is a item where we need to specify the other item. We should mention that particular other incomes in clause number 16, and if yes, then CPC is adding that income into the PGBP. So how to deal with the notices and how to report this clause 16? What are your views?
Sir, we are auditing the books of accounts of the auditee. So whatever normally in proprietorship concern, the business books of accounts are different as compared to the individual personal accounts are concerned. So when we are everything which is being credited to the capital account of the SSC in the books of accounts, only in those clauses we are supposed to report for that. Since we are auditing the books of accounts and not in the individual personal balance sheet, so our report will be restricted to the books of accounts only. So whatever amount which has been credited to capital account, if it is not in the nature of income falling within the proviso of section 28, then those things need not be reported in clause in the clause 28, clause 15, point number 28. Since in a proprietary concern, we come to see that certain items of income are being credited to capital accounts since they are forming part and parcel of the books of accounts. Therefore, somewhere or other there is a need to report this. Earlier we were reporting under this column any other item of income, that is rent, interest, saving account interest, or many other items of income which are not falling within the purview of section 28. So our latest guidance note, draft copy of the guidance note, now it says that these items, if you are intending to report this, then you report in the observation column of Form 3CA or 3CD. There only you are supposed to report. Otherwise, when you are auditing the books of accounts of the SSC and those entries which are not falling within the purview of section 28, there is no need to report. That is my view. Thank you, sir.
Okay, great, sir. Thank you. Next question is to Atul, sir. Whether the security deposit taken under any contract is to be reported in clause 31A. What is your view?
Yeah, this was regarding secret deposit, and deposits are taken under various reasons, either for the purpose of agency deposit or some contract you are giving for construction, and some other deposits on which you give the property on rent, on which you have entered into agreement with them with a specific clause of deposit. that specifically needs to be considered. Normally, this is the webinar by QB. So normally, it has been skipped by the auditors. That is not mentioned in their tax audit reports. That is need. I'd like to highlight that point. However, for example, you have taken the security deposit for the construction of work, and you have kept some retention money out of that. But that retention money will be payable after some time. That need not be should be considered as a deposit, and that need not to be reported. However, whatever the security deposit you have taken initially, if you have repaid it, that you have to show in the 269D, and if you have take acceptance, you have to show in the 269SS of the Act. Thank you very much.
Thank you, Atul sir. Next question to Sachin sir. What are the steps to be taken by tax auditor while examining the particulars of payments made to persons which are covered under Section 48(2)(b)?
Hello all. This question relates to clause 23 of the tax audit report in Form 3CD. So when we are reporting this in this clause regarding the payments made to persons, there is also a problem that the definition of relatives is different in many places. So the first and foremost thing is to find out like what is the definition of relatives under 48(2)(b) first, because under the Companies Act it is different. Even in income tax at some places it is different. So we have to specifically see the definition of relative as per 48(2)(b). So the first step is that we have to obtain the full list of specified persons as contemplated in this section. This information you can get from the SSE, and you should cross-verify from the data available with the SSE. Like you can take the members register or the list of directors, the register of concerns in which directors are interested in case of companies, or you can also take the list of members, directors, trustees in case of cooperative society, trust, etc. After you get this list, you have to obtain the details of payment made to the specified persons. So first is to obtain the list, next is to obtain the details. Then in the next step, you have to scrutinize all items of payment made to the above persons. So the scrutiny has to be done whether the payments which are covered under 48(2)(b), which are to be reported, and the name of the persons, whether it is correct. Then sometimes it may be difficult to locate these payments, and it may also be a time-consuming effort. But it is always possible to localize the area of inquiry by following these 3 steps. We can call for all contracts or agreements entered into by the SSE, and we can list out the contracts or agreements entered with the specified person and segregate the items of payment made to them under these agreements. So once we have got the agreements, we can scrutinize the agreements whether they have the payments as per Section 48(2)(b). And in case of purchases and expenses on credit basis, we have to scrutinize the ledger accounts to identify the dealings with the specified persons. And sometimes it may happen that the payments are not reflected in the ledger because it is made in cash. So sometimes we'll have to scrutinize the purchase or the expense account also, where it would be directly the payment may be made in cash. So instead of the ledger, we have to scrutinize the purchase or expense account. Sometimes due to the volume being huge, it is difficult to identify all such payments. So we have to restrict the scrutiny only to such payments which are in excess of certain monetary limits, depending upon the size of the concern and volume of business of the SSE. So we can do a test check for that payments. The next step involved is that in case of large company also, it is not possible to verify the list of all persons. So we have to rely upon the information provided by the SSE. We have one good circular issued by the CBDT. It is circular number 143 dated 20th August 1974. So in that, it has been clarified that the tax auditor can rely upon the list of persons covered under Section 13 (3). which is like given by the managing trustee of a public trust. So based on this circular, we can rely upon the list provided by the SEC. So when the tax auditor relies upon the information furnished by the SEC, so appropriate disclosure has to be made that we are relying on the list provided by the SEC. So MRL and all we have to take. Also, the auditor may refer to the details given in the annual accounts for related party transaction as per AS 18. So as per AS 18, as I said earlier, in Companies Act, we have to disclose the RTP, the related party transactions. So that can be, examined, and then if it is available, we can examine and report under this clause. So we have to differ also in this case. Then we have to find out the difference between the relative as per the definition of related party as per AS 18 and the person specified in section 48(2)(b). So again, we have to segregate whatever is covered under 48(2)(b), and only that list we have to find out from out of the total list obtained under section under the related party transactions, and accordingly we have to fulfill our obligation in this clause 23. So thank you.
Okay, thank you, Sachin sir. The next question is to Jayaprakash sir. It is regarding clause 16. Whether perquisites received in cash in business, generally, normally we not credited to profit and loss account. So my question is how to identify these kind of perquisites and how to report them.
Since our audit is basically restricted on the books of accounts maintained by the assessor. What is stated in the books of accounts, that only we can record. We are receiving incentive in the form of cash, we are receiving incentive in the form of kind, some gold, travel incentive and all. Unless and until we take a representation from the management regarding that no such perquisites or perquisites are received so and so, then only we are able to report in the form 36. Now we have a new section in income tax, section 194, any perquisites, the provider of the perquisite has to deduct TDS on that. Based on 194R and 26 years of the SSC, we can get a conclusion that these are the amount of perquisite which are received by the SSC, and subsequent a letter, representation letter from the management that no cash incentive or perquisites have been received which are outside the books of accounts. That will suffice. Hello, thank you, sir. I'm
Hello.
audible, sir. Yes.
Sir, your voice is not getting clear.
Now, sir.
So little disturbance was there. Yes, now we are here.
Okay, sir.
But thank you, sir. Thank you for your insights. Next question is to Manohar, sir. This kind of situations arises many times, like when we sold or transfer assets such as building, plant and machinery of the closed business, and the value of that assets are, lesser as per the, whatever the amount we receive is more than the book value. So in that case, what would be the remedy?
See, if we close the business and sell the assets, if the assets are depreciable assets, then the section 50A will apply over there. Section 41 will not come into the picture. And if we sold the depreciable assets more than the book value, such profit will be a short-term capital gain, needs to be reported under section 50A. And section 41 doesn't apply in that case. And that need not be reported under clause 25 in form 3CD. Okay, thank you.
Thank you, sir. Next question to Atul, sir. Share application money received, whether it is to be considered as a deposit?
Yeah.
What is your opinion?
Yeah. It's a good question, I would say. Before we discuss to do that, let us first recapitulate what 269SS is. Okay, clause 31E talks about you have to report about any transaction of 269SS. This clause is 269SS is under which you cannot accept loan or deposit in excess of the amount specified specified there. For example, limit is 20,000 rupees, and in addition to that, you cannot accept that money in either in cash or otherwise an account with check. Share application money is basic character of the that money has been received is to just to apply for the purpose of shares, and that doesn't partake the character of deposits. So normally it should not have been part of the term as a deposit, provided all documentary evidence of in the case of company do have that it's really a genuine case of share application money. In that case, it should not be found part of the deposit and as or either loan also. Hence, it should not be reported under clause 31A itself. And there is, however, there both the sides of judgments, most of the are in favorable judgment. However, one caution has to be taken. There is one Bhattacharya Engineering Works Private Limited, 275 ITR, page 99, which has a negative decision against the assessee. In that case, it has been told that it should have been termed as a deposit and it should have been taken in the clause 31A. This is the situation. For the practical purposes, it basic character does not form part of the loan. You have to repeat. Otherwise, if you not share is not allotted, you'll have to repeat again. So it should not be form part of the loan or deposit. Thank you.
Okay. Thank you, sir. Next question to Sachin, sir. This is, I guess, important question. What are the items to be included or excluded in valuation of inventories? What is your thoughts?
Yeah. So this is concerning clause 14, valuation of inventories. So again, in this, we have a very important judgment of CIT versus British Paints Limited, 1991. The citation is 188 ITR 44. It is a Supreme Court judgment. So in that, the Supreme Court has held that the method of valuation of stock at actual cost of raw material and not taking into account overhead charges was not the correct method of valuation, even though the said valuation has been consistently followed. Now, if we see AS2, valuation of inventories, it says that the cost of inventories should also include a systematic allocation of fixed and variable production overheads that are incurred in converting the materials into finished goods, and the allocation of fixed production overhead should be based on normal level of production only for the inclusion in the cost of inventories. Also in AS2, it has been provided that overhead should be included as part of the inventory cost only to the extent that they clearly relate to bringing the inventory to their present location and condition. So I'll just brief about the case as to what happened in that case in case of British Paints Limited. The British Paints Limited consistent practice was to value the goods in process and finished goods exclusive at cost of raw materials, and they were not including the overhead expenditure in that. The stock in trade had been valued at 84.49%, representing the actual cost of raw material. Overhead charges of 15.51% were excluded from the SSC's valuation of stock. And in that case, SSC was justifying that goods being paints had limited storage life. So if not quickly disposed of, they were liable to lose their market value and all that things. That contention was rejected by the ITO. He observed that at no time had the SSC claimed any deduction on account of deterioration or damage of goods. So when he's saying that it has a less shelf life, and at the same time he's not claimed any deduction, then that things don't gel. So the ITO further held that there was no justification to recognize the practice because the well-recognized principle of accounting was to value the stock at cost or market price, which is lower. So he was held that it should be held at 100%, and he wanted to include the overhead expenditure. So the case went to the appellate level, where the tribunal held the ITO's order. Then it went to the High Court. However, in High Court, the High Court rejected the ITO's claim and it sided with the SEC, and it said that the tribunal was not justified in rejecting the SEC's method of valuation. And finally, on appeal, it went to the Supreme Court, where the Supreme Court observed as follows, that it is not only the right but also the duty of the assessing officer to consider whether or not the books disclose the true state of accounts and the correct income can be deduced therefrom. So it is not correct that the officer should accept the system of accounting regularly employed by the SEC. The officer is not bound by the method followed in the earlier years. Then the Supreme Court went into section 145, and then it said that in computation, for finding out the correct profit and gains, we have to find out the method which is really followed by the SEC. And if the real stock in trade is not meant, then the books of accounts also may be false. So on that basis, the Supreme Court held that the ITO was correct, and overhead cost has to be included. So based on this judgment, we can very well assume that whenever we value the stock, we have to bifurcate between the three items. Particularly in case of manufacturing concern, the three items, that raw material, work in progress, and finished goods. And accordingly, we have to value based on the principles of AS2 and Section 145 together. So giving it a colorable thing is not at all permitted. Thank you.
Great. Thank you. Next question is to Manoj sir. Many times we see that in our books, there are many liabilities which are pending since long. There might be little changes, but there are so many liabilities which haven't changed due to the reason might be the vendor has not asked, or there are some issues in which we are ultimately not going to pay that liability. So, what would be that scenario in this case of this long pending liability, sir?
Actually, I have told earlier, clause 25 covers only the cases where the SEC writes off or shows the liability as seized or remitted. In this particular case, the SEC is showing the liability, but it is long outstanding. See, as far as he is showing the liability in his books as his liability, Section 41 doesn't come into picture. As far as he is showing it as a liability, he is accepting the liability. He is not denying that he is not able to pay, or say he is not liable to pay the liability. As far as he is showing the amount as liability, and though it may be outstanding since 4 years, 5 years, or with a little change, it is remaining as liability. In that particular case, the liability doesn't considered as remitted or seized by the virtue of Section 41. And in that particular case, we have to obtain the information from the client, how long it is pending and why there is little change, whether he has paid something or he has received some goods from clients and the liability is increased or decreased by that. That needs to be verified. See, as long as he is showing liability, that can't be assumed as remitted. Section 41(1) doesn't come into picture, and we need not report the same under clause 25. The same scenario was observed by the Delhi High Court in CIT versus Vardhaman Overseas Limited. The correct citation is 2012 343 ITR 408. Delhi High Court case was there. So as far as the SEC showing the same as liability, Section 41(1) doesn't come into picture. Thank you.
Okay, great, sir. Thank you. Next question to Jayaprakash, sir. If employee's contribution to PF is not paid before due date, that is income as per the Section 224, and it is reported in clause 20B, then whether the same has to be reported again under the clause 16?
In 224(10) is with respect to employees' contribution to the provident fund. employees, when salary is paid and employees contribution, we are deducting from the salary of the employee. So once that amount has been received, it is as per the definition of income, it first becomes the income, and subsequently when it is paid, it is allowed as a deduction under 36(4)(a). Now in this case, we have a two scenario here reporting requirement. One under clause 16 and second under clause 20. So the specific information has been asked in clause 20 with regards to the whether the employee's contribution to PF has been paid on or before the due date or not. And since it is forming, if it is not paid before the due date, it becomes the income of the SSC. Then whether the same is required to be reported under clause 16. Clause 16 says income not credited to profit loss account. Since this income which is not credited to the profit loss account needs to be reported, our problem is that if we report at these two levels differently, there will be double addition as per the CPC formula. So we have to report this clause under clause 20 and make a cross reference under clause 16 that there is an increase in there is a delay in furnishing the payment of a PF contribution, and the same has been reported in clause 20A. Cross reference has to be made for this. Thank you.
Okay, great, sir. Thank you. Next question to Atul, sir. Whether in section 269T, we have to report the receipt of capital nature?
Yeah, this is the I think it must be section 269 ST. Before we go to that, let us understand what 269 ST is. Okay, 269 ST prohibits to accept, receive a sum of rupees 2 lakhs or more in aggregate from a one person in a day for a single transaction or in respect of one event for multiple transactions. It may be amount may be less than 2 lakhs, but if it is for one event, it exceeds rupees 2 lakhs, you cannot accept it. This is what is section 269T. The wording in the section 269T is receipt of the money, or receipt of the sum. So it doesn't have any character or doesn't have talks about any the character of the money, whether it's a capital or revenue receipts. So unfortunately, whenever we come across the money has been received more than 2 lakhs rupees in otherwise than cross check or demand draft or other methods which have been approved, unfortunately we need to have to be reported in clause 31BA.
Okay.
Thank you.
Thank you, Atul, sir. So, in connection with the last question, Sachin, sir, you are talking about what is to be included and what is to be excluded while, valuating the inventories. Now, I would like to ask that which method is to be followed for the valuation of inventories, and what is the interplay between the section 145 of Income Tax Act and the AS2?
Yeah, it is a very important question since many chartered accountants face this dilemma. So, as you all know, friends, we have two methods of valuation of inventory. One is called the exclusive method, and the other is called the inclusive method. So, in the exclusive method, the output GST is credited to the GST account in the liability side, like duties and taxes. The input GST is also credited to that account, and the payment is also credited to that account, credited or debited, whatever it is. So in sum, the net amount of GST payable or refundable is shown in the balance sheet in the exclusive method. So it does not affect the trading and profit and loss account in the sense input GST is not included in the purchase, nor is output GST included in the sales. All are routed through the, you can say balance sheet. So it has no effect on the profit and loss account. But the other method is the inclusive method, in which suppose we have paid say 18 rupees GST on purchase of 100 rupees, then we show the purchase at 118 and not 100. Similarly, in case of sales, we add the GST to the sales amount, output GST, and show the total amount. So in this way, the inclusive method works. Now, if you see AS2, the accounting standard 2, it talks about the exclusive method. It says that while valuation of inventory, we should follow the exclusive method, wherein, as I said earlier, all the items of indirect taxes are excluded from the profit and loss account, and net amount is shown in the balance sheet as payable or receivable. But if we see 145, section 145A, so that section specifically talks about the inclusive method, that while valuing the closing stock or the inventory, or while following the method, you have to include all the items in the profit and loss account itself, and accordingly you have to value the stock. So in this regard, the question asked in the clause 14 is that what is the method of accounting? That all we know that we will say that it is cost or market value, whichever is lower, which is the standard method we have to follow. But the second question is asked is whether the SSC has followed section 145A while valuing the inventory. So in this regard, since everybody is following the exclusive method as mandated by AS2, the answer will be no. So, but then the dilemma is that if we say no, immediately maybe we may get some notice or something. So first of all, we have to take the representation from the SSC. In this regard, I'd like to tell you 3 case laws which I have gathered regarding this method of valuation and exclusive method. So if you want, you can note it down. The first case law is Berger Paints versus CIT. It is reported in 187 CTR, 193 page. It is a Supreme Court case. The second case is CIT versus Indo-Nippon Chemicals Limited. It is reported in 261 ITR, page number 275. Also, it is a Supreme Court case. And we have one more important case of Lakhanpal National Limited versus CIT. It is reported in 162 ITR, page number 240. It is a Gujarat High Court case which was never contested by the department, and it was finalized at that level. And this Lakhanpal case has also been mentioned in the other cases like Berger Paints and all. So in all these 3 cases, the Supreme Court or the Gujarat High Court has held that the method of accounting should be exclusive method, and this taxes and all should not be included, and they have gone with the AS2. So what I suggest is that whenever you are not following 145 and writing no, then in the 3CP or 3CD where you have to give comments as an auditor, so you should mention that the auditee has said that it is not following 145A, it is following AS2, and he has based his judgment on these 3 cases, and accordingly we have accepted, and valuation of inventory has been done as per AS2. So I want to say that if we see the sum of all these things, even if we follow 145A or AS2, the net effect on the profit and loss is never the same, because mathematically it has been proven that whenever we add the tax or deduct the tax from all the 3 items like opening stock, all the items like opening stock, purchase, sales, or closing stock, the net effect is 0. Like if we add the tax, the profit will be the same, or if we don't add the tax, again the profit will be same. Maybe in some cases it may not happen, but in most of the cases, the net effect on the profit is not there, like whether you follow the inclusive or exclusive method. So we have to follow AS2, and the adjustments or the other method that we can do is that we can prepare a small, a note wherein we say that as per AS2, this is our method of valuation of stock, and we have valued it as per AS2. And we write down the adjustments as envisaged in 145A, wherein we say that we say the opening balance of stock as per AS2. Then we add the taxes to that of the output tax, or we deduct the input tax, and add less karke whatever we get. We find that the net amount effect will be 0, and we'll get the same closing stock. So that working we should keep with us. Like as per 145 also, this is the stock that we are arriving at, and we should keep it handy as to whenever the department asks for it, we can produce it and justify our claim that why we have followed the exclusive method, and why it has not impacted the method of valuation under inclusive method under 145. So this is a very important thing or working that we have to do, because afterwards this may create some issues. So reporting and keeping all the workings and disclosure in the main 3CB or 3CA is an important step that you have to follow while this clause 14 is being adhered to. So thank you. Thank you all.
Okay, thank you, Sajin sir. Next question to Manoj sir. Whether the conversion of loan into equity share capital be treated as a cessation of liability?
See, when we are converting the loan into capital, the loan is nullified and the amount is transferred to capital. Loan was liability and that has not been seized or remitted. See, actually what happened? The liability of loan has been converted into capital. The same amount has been treated as capital of the company or say personal business. In this particular case, the liability was not remitted. It was not seized. The person who got the liability converted into capital doesn't have any benefit from that. That's why the liability so converted into loan need not be treated as liability seized or remitted, as the loan has been made out, and this against that fulfillment of commitment of loan, the share capital or shares have been issued. This particular case also doesn't come under the purview of section 41. That's why the same need not be reported under clause 25. Thank you.
Okay, thank you, sir. Next question to Jayaprakash sir. What if the difference in actual consideration of sale of immovable property and the stamp duty valuation is less than the 110% of stamp duty value? So what is actually needs to be reported?
The clause section 43CA deals with applies to a builder or a person dealing in immovable property, builder and dealing in immovable properties. There, the immovable property is a stock in trade for the builders. Section 43CA is specifically applicable in those cases where he sells the property less than the stamp duty valuation. A leverage has been provided in the Act of 10% of the sale consideration. Now the reporting requirement says that if the difference between the stamp duty valuation and the sale value is less than 110%, then there is no need to report in these clauses. We have three clauses in this. Clause 17, details of property, consideration received or accrued, value adopted or assessed or assessable, whether the provisions of section 40, provisions of second proviso to section 43CA or fourth proviso to clause 10 of subsection 2 of section 3 are applicable to the associate. Since we have been given the leverage of 110%, and if it falls more than 110%, then full amount is to be reported, not necessarily the difference between 110% to the actual sale consideration, stamp duty valuation. As far as section 50C is concerned, 50C comes into play with respect to a capital asset. If the same is reported in the books of accounts, same is in the books of accounts, then only there is a need to report as far as the 50C is concerned. If our individual books of accounts are different and the business books of accounts are different, and these entries are appearing in the business books of accounts, in the personal books of accounts, then I think there is no need to report under this clause, because our audit observation is based on the books of accounts we have verified. And second thing, if the same entries are appearing in the books of accounts, business books of accounts, then there is a need to report for this clause. If we are reporting under this clause, different situations will arise. We have to verify the actual registration documents, whether the stamp valuation or the actual consideration, there is a difference of more than 110% or both are same. Based on that, we are supposed to report on this clause. Now the ambiguity is, if we are falling under section 243A, clause 17 is also applicable for this, and again clause 16D says any other item of income not credited to profit and loss account. Since similar situation also will arise as earlier also in the PF case, where that is forming part and parcel of the business income. Since this is a specific clause, under clause 16, we have to cross-reference to this clause so that our reporting will be completed. If we are reporting under both these clauses, then there may be certain issues with respect to CPC that both amount will be added to the total income based on the tax audit report. Not mentioning the amount in clause 16D and mentioning the total quantum of the amount in clause 17, that will suffice the purpose, and the reporting requirement will also be fulfilled. Since we have also cross-referred that particular item to clause 16D, that will give the clause 16 that will suffice the purpose. Thank you, sir.
Yes, thank you, sir. Next question to Atul, sir. Many times it happens that we settled our loan accounts with the journal entries. Like we did some barter transaction or something. In that case, we settle our loan accounts. So whether it is to be reported or not, what is your view?
This is the big practical difficulty. It's a
Yes.
relevant topic you have raised in this webinar. Many times, what happens, some way you are a loan creditor and some way you debtor, and you just interway pass the journal entries in between of them, and you settle that account. It normally happens in the books. Otherwise, they doesn't want to pay it and came back because whether that money will receive it to his back or not, that the practical issues they have. Unfortunately, I don't know, there are old members who might be having that situation where we are filing physical audit report and we're signing and that we are submitted to income tax. What we can do at least, in that column we are writing paid by journal entries. That was the option was available because it was a physical moment of time, and this is old problem, not a good problem. However, after the introduction of e-audit report and utility doesn't allow that method stating anything either with account page check or without account page check. This is the only option they have given. And 269 SS as well as T, because account is settled, so section 269 T will prevail here, and which prohibits to payment otherwise than by account page check or demand draft or other electronic modes as per rule 6A BBA, which has been notified in 2019, September 2019, where only credit card, debit card, net banking, IMPS, UPI, and some RTGS, NEFT are being only these are notified where you can repay that amount. Otherwise, it is not within the preview of section 269T. So unfortunately, we will have to report there because whether it is as per law, no, it is not as per law. The law doesn't provide you the liberty to pay by journal entries. However, there are certain judicial pronouncement which I have with me. Even we have reported, but when there is reasonable cost to receive deposit through the journal entries, this is one Bombay High Court judgment, but Ajitnath Heritage Builders Private Limited 2019 412 ITR, page 306 Bombay High Court, which says that when you have a genuine reason to settle deed by way of journal entries, it should have been allowed. This is what the Bombay High Court did, but one has to take this as far as auditors are concerned. I will. I have a view that we have to report it, but what department will take, and then we have to face that. That we'll have to cope up with that. But as far as audit report is concerned, we will have to report it there. Otherwise, then account we check and demand draft. But in the case of notice has become, we can take the judicial guidance given by the earlier courts also. Thank you.
Okay, thank you, Atul sir. Next question to Manor sir. Sometimes it happens that the liabilities is already been paid, but erroneously it is still showing in the balance sheet. So it will attract the provision of section 41(1) or how?
See, such a thing may happen. Actually, erroneously, some entries might have been remained to be written off or say consolidated. See, in this particular case, if it is still showing as liability after repayment of the liability, then in this particular case, the auditor needs to go for last year's audit reports or last year books of accounts where the entry was made. How the entry was passed in that particular year needs to be verified, and rectification entry needs to be passed in the current books. See, in this particular case, the entry is rectification entry. The amount of liability is shown erroneously, which has been already paid. In this particular case, we need to pass a correction entry, and provisions of section 41 need not apply. Why? Because the liability has been already paid. So it doesn't amount to remission or cessation of the liability. The double benefit or double writing of the entries, or say disallowing the amount twice, that doesn't have any meaning. That's why the auditor needs to take care and verify and go for the last year's books where the liability was paid and what wrong entry was made over there, that needs to be corrected in the current year by way of reconciliation. Thank you.
Okay, thank you, sir. Next question to Jayaprakash, sir. We need to show capital receipts under clause 16E. But what about the exempt capital receipts? Whether they also to be reported or how?
The clause 20 under clause 16 of the tax audit, the key column of capital receipts. Capital receipts has not been defined as per the income tax.
Sir, your voice is again cracking.
Now it is clear, sir?
Yes, sir.
Yes. Capital receipt has not been defined in the Income Tax Act. We can go through the various judicial pronouncements. But what is to be stated in clause 16 in the column of capital receipt is whatever amount which has not been credited to the profit and loss account, that has to be shown in this column only. Rest of the income which are exempt, the same treatment has to be given, that they are exempt. Based on the exemption, they are to be reported in Form 3C under other observations if needed. What are the receipts which are in the nature of which are capital in nature, but they are not credited to profit and loss account? Our guidance note says that any subsidy amount received, which is received with respect to the capital contribution, any profit on sale of fixed asset, that is over and above the block of asset, then those amounts are not credited to profit and loss account. Those columns are to be only reported in clause 28 of clause 16, clause E of the tax audit report. Other items which are not in the nature of taxation, which are not liable for taxation, those particular heads of income are not required to be reported under clause 16E. Capital receipt, in our opinion, is any sale of any movable property. But if it is chargeable to tax, then only it is to be shown. If it is chargeable to tax and it is incorporated in the regular books of accounts, then only that needs to be shown in the tax audit report. Otherwise, there is no need to show those amounts in the clause 16E of the tax audit report. Yes, thank you very much.
Okay. Yes, thank you, sir. Question to Atul, sir. Whether the amounts which are outstanding on 31st March, which are mentioned under section 36(1)(5)(a), is paid on or before the due date under section 139(1), whether it can be claimed as a deduction?
There is a lot of anomaly and was there earlier before Finance Act 2021 is to be give explanatory clause. Before that, let us understand what 36 VA is. 36 VA prohibits you to get any sum received by an assessee from his employees, to which provisions of section 224(10), well, that's what Mr. Feroza was discussing about, that any amount which is received, it is income, and amount which is credited to that account and which is not paid on or before the due date of that act is to be treated as a disallowance. Okay, this is what the 36 VA states. And 224(10), which allows you income tax law himself is treated as the income of any amount received by an employee towards his contribution to any provident fund or statutory fund. So that is an income for the person who receives it. However, and the expression 5, which has been inserted by Finance Act 2021, which has been clarified now that the section 43B will not apply to the income which is specified by the section 224(10), subsection 10. So, explanation after this explanation, earlier also there are quite judicial pronouncement. Some of them saying you can apply 43B, some of them saying you cannot apply 43B. But now it has been settled law that in order to pay it, take the deduction, you have to take due date under that particular law. If that due date is unfortunately you have missed it, that amount which unfortunately is not available as a deduction by way of by virtue of section 36VA, and even you pay by before 139 or even for the single day, that amount is unfortunately not to be deducted as expenditure in the books of the assessee. That's what the law is. Thank you.
Okay, thank you, sir. Taking at the section 43B, I will ask one more question to Manohar, sir, regarding this section. Where taxes and duties, which are referred in 43B, are paid after the tax audit is completed, but before the due date of filing returns. How should be the means how we can deal with that by as a tax auditor?
See, section 43B talks about the payment of liability, and the deduction is allowed only on payment basis. If it is paid before due date of filing return of income under section 139(1), then the deduction is allowed in that particular year. If it remains to be paid, then the deduction is allowable in the particular year in which it is paid. So we, as a tax auditor, we are doing tax audit. At that time, we came across an entry that 2 crores say have been shown as liability towards GST or any tax, and out of that, till the date of audit, conclusion of audit, only 1 crore 50 lakhs have been paid. So remaining 50 lakhs, if the assessee pays after the date of audit but before the due date of 139(1), then the same needs to be shown in the computation of income, and the assessee will get deduction. So by the time of conclusion of audit, the auditor need to show that this much amount has been paid till the date of audit, and this amount was remained to be unpaid. So we have to report under clause 26 accordingly. Thank you.
Okay, thank you, sir. Next question to Sachin, sir. As per clause 23, so what are the information and what are all working papers need to maintain by tax auditor for the purpose of reporting?
Yeah, so in this case, actually, we can say that it is mentioned already in the e-utility. When we are filing the 3CD, we have to adhere to the e-utility provided by the department. So according to that e-utility, we have to maintain 7 columns. I'll just tell you the columns that we have to maintain. The columns or information that we would try to require in the working papers are, firstly, the name of the related party. Secondly, the PAN of the related party. Third, we have to also take the Aadhaar number of the related party. Nowadays, it is necessary. If it is available, we have to take it. And the fourth column would relate to the relationship, the actual relationship of the related party. How is related to the assessee, whether son or daughter or wife, whatever is the relation. Then the next item in this would be the date, like when this transaction took place, the date of the transaction. And sixth column would be the nature of the transaction, whether it is, the payment is made for purchase or towards interest or towards salary, like that. And the last really will have to maintain the details of the amount paid, like towards each head of transaction, how much is the amount that has been paid by the SSC to the related party. So these 7 columns we have to prepare, and in that we have to put the information related to the related party for reporting under clause 23. It is as per the utility provided by the department, the e-filing utility for Form 3CD. So thank you.
Okay, thank you, Sachin sir. I got one more question for Jaiprakash sir. As we were talking about clause 16E, whether the loans and borrowings are to be reported under this clause as a capital receipt? So we are not able to hear you. I guess you are on mute.
Voice is muted.
Sir, unmute yourself, sir.
Yes.
Yes, sir.
Loans and borrowings are not in the nature of income. So they will not form, they will not be part and parcel of the capital receipt. If it is in the nature, if the loans and the deposits are in the nature of income, then only it will go to the capital receipt. Otherwise, such as gift received, if it is received from relative, then definitely it will be out of the ambit of taxation. If it is received in the nature, if it is from other persons, then also it is in the nature of capital receipt chargeable to tax. Therefore, the same needs to be reported under this clause under the capital receipts. But loans and borrowings definitely are not to be reported under clause capital receipts. Thank you.
Okay, thank you, sir. Next question to Manoj sir. Whether the conversion of interest liability into loan or share capital be considered as a payment for the purpose of section 43B?
See, when a person gets a loan from any bank and interest is due, the interest is shown as expenditure in profit and loss account. The same is a business deduction and is allowable to the concerned SEC. When the liability was created for interest and subsequently if the same has been converted into loan, the basic nomenclature of that particular amount of interest remains the same. The court have opined that the amount of such interest, although it is converted into loan, is the basic nature of the same amount is interest, and that needs to be disallowed under section 43B, although it is converted into loan. Thank you.
Okay, thank you, sir. One question received from the audience for the Sachin sir, that while doing the audit of share trading, so the person who is doing a share trading and he's applicable for the tax audit. So that in that case, whether the inventory valuation is to be done at the cost or NRV? What is your view?
It's a very good question. For this, we'll have to see ICDS, the Income Competition and Disclosure Standard, which has been issued in terms of section 145. And also we'll have to see 145A, which talks about valuation of inventory. So if we see all this in together, there are many scenarios that may come to us. The first scenario is that actually the section 145A says, and the ICDS says that whatever stock we are valuing or whatever inventory we are valuing, whether it is shares or whether it is other inventory, it should be at the actual cost or the net realizable value, whichever is lower. And it should be calculated as per the ICDS rules of section 145(2). Now, in case of shares, there may be different scenarios. The inventory may be listed or unlisted. It may be quoted or unquoted, like that. So when a shares is not quoted on a recognized stock exchange with regularity from time to time, it should be valued at the actual cost initially recognized as per the ICDS, and notified under section 145(2). So whatever the cost it is there in the books of accounts, if it is not regularly traded, because we'll not be able to find out the current market value in that case, should be valued at the cost in case of unquoted shares. When the shares are otherwise, that is, they are quoted, then it should be done at the lower of actual cost or NRV in accordance with the ICDS. Also, there's one more clause which says that if there are scheduled commercial banks and public financial institutions, so they must disclose the inventory as per the guidelines issued by the RBI in this regard. So these are the three scenarios that I'm looking at. So all in all, the valuation of inventories and listed securities shall be done at the price of NRV or actual price, whichever is lower. So this is the answer to that as per the law as it stands today, that is 145A. Thank you.
Okay. Thank you, sir. This question to Manoj, sir. Whether the
Yeah.
professional tax liability is required to be reported under 43B?
Yes, as that is a tax that needs to be reported under section 43B and allowable under on payment basis only.
That is
Okay. Okay.
one thing I would like to add is, if it is deducted on behalf of the employees, then there is no need to qualify that, no need to report that particular item of professional tax. We deduct professional tax on behalf of the employees also and deposit to the department. So that amount is not debited to profit and loss account. Therefore, it will not come under the purview of reporting for professional tax, in my view, sir.
Yeah, that's right.
Okay. Great, sir. Sir, next question for you, Jayaprakash, sir. What are the reporting requirements for clause 17, 43 CA and 50C, where land...
I think we already covered this clause.
Clause 17 did not cover, I guess, sir.
C and 50C we already covered initially.
Okay. So, whether land and building or both is transferred for consideration less than the stamp duty valuation. So whatever we have covered, there was the question of 110% difference.
Okay.
Yes, difference is less than 110%. Then what is the remedy? And now, here's the question: is that yes, exactly in that question you have covered this, but that was the specifically different, differently given this person. Yes, exactly. So
Clause 17 specifically with regards to the building, land or transfer of land or building or both is transferred during the previous year for a consideration less than the value adopted or accessible by any authority of state government referred to in section 43A or section 50C is furnished. The columns mentioned in the details, whatever the asset has been transferred, details of property, consideration received or accrued is also important, value adopted or accessible as per stamp duty valuation, whether provisions of second provision to subsection 1 of section 43 CA or fourth provision to clause 10 of subsection 2 of section 56 are applicable. That is, when we talk about section 43 CA, definitely they are recorded there. That is the income forming with it. If it is a dealer in immovable property or a builder, then definitely those incomes are to be reported in 43 CA only. If the difference in stamp duty and the actual consideration is less than 110, is more than 110%, then the total, if the difference is more than 110%, then the total difference is to be reported. Not only the over and above the 110% is to be reported, total difference is required to be reported. And if the difference is less than 110%, then I think there is no need to report under this column. Whether the provisions of second provision to subsection 1 of 43A, since the difference is less than 110%, so I think there is no need to report for those. Even our guidance note has been draft guidance note, which has been the same issue has been also mentioned in the draft guidance note also. Section 50C is concerned, that is with regards to transfer of a capital asset of immovable property, capital asset, immovable property, land, building or both. And stamp duty valuation, similar provisions also there. There are also leverage of 110% is also provided. If it is a capital asset, then income will fall under section 56 to 10. So there is a need to report under section 56 to 10 if the difference is more than 110%.
Okay.
Yes.
Yes. Thank you, sir. Yes. Now, question to Atul, sir. In case the assessee has not deducted the tax and furnished a certificate in Form 26A as per Rule 31 ACB, whether we have to give the details in Form 3CD?
Yeah, this is basically provision has been made to cope up with the draconian procedure for TIA. See, as you are aware, for TIA initially introduced, there are a lot of disputes has been taken. It's somebody was talking payable basis, then only for TIA applicable, then amendment has been made. And initially it was 100% disallowance, then it has come down, brought down to 30%, which is very injustice to the assessee because he has already incurred the expenditure. And only because the procedural lapses, which is we have to work on behalf of government and we have to deduct the TDS and pay to the government, that is the lacuna which we have done, and penalty is too high that 30% expenditure is not allowed as a deduction. However, now there is one proviso has been added in 40 AIA where in the case you have been not to be declared as deemed to be default under section 201 subsection 1, in that case the amount will be allowed as a deduction. That is what the law says. And section 201 gives some certain conditions on which assessee will not be treated as a deemed to be default. And that conditions are P is furnished is that P has to furnish his return of income well within the time allowed under section 139(1). Then P has to take into account that whatever the payment you have made in his books of accounts and he has shown as an income, and P has paid his tax, whatever tax due, whatever income he has shown in the return of income. So he should not be have their default and he has not paid tax. That will not be case. And one thing duty has been cast on the chartered accountants where by a chartered account has to certify that each chartered account has to certify that all these things has been complied with. In that case, if we have able to do it, get it the certificate from a chartered accountant, in that case we can claim it as a deduction and the section 40 disallowance will not be attracted. However, there are practical difficulties. That's why I said it's a redundant clause because no. First condition is that the P has to be filed his return of income 131, and you will have to also file the return of income under section 131. Suppose, and in that case, what happens? No, it is very difficult to get that certificate from a payee, and there is no control of yourself on that payee whether he files, whether he is in default, then you have a problem. In that case, however, if all things have been happened and if you have satisfied the conditions mentioned in section 201 subsection 1, you will definitely get the credit. However, as far as reporting under CCD is concerned, in the reporting of the CCD, it doesn't talks about anything about this. Reporting under section 40 AIE, which says that you have to report cases under which tax is required to be deducted, which is deducted but not paid first, or if it is not deducted, to whom you are not deducted, that is to be reported. So it will be advisable, or it will be recommendatory or rather mandatory to report that all disallowance, whatever the tax has not been deducted in 40 AIA. And if at all, if assessee able to get that certificate from the PE chartered accountant, in that case, he can claim deduction again. In that case, that would be a situation in this 40 IA as vis-a-vis section 2011. Thank you.
Okay, thank you, sir. One more question from audience for Sachin, sir. Whether the receipts from relatives as specified under section 56(2) is to be reported anywhere in Form 3CD or in audit report?
The answer lies in the question itself. Since it is covered under 56(2), naturally it is a case of income from other sources. So in the audit report, we are doing only dealing with the profits and gains of business or profession. We are not dealing with the concept of income from other sources. So when the income is reported under IFOS, so naturally there are no clauses wherein we have to report the relatives payment received is like a gift and it is not to be reported. Nevertheless, there are two clauses specifically in section 56.2 because 56.2 has a long list of sub-clauses. So I'll just touch upon two clauses. One is 56.2, you can say 7A. In that case, clause 28 of Form 3CD is there, which talks about unlisted shares received by companies, firms, or LLPs for inadequate or no consideration. So, when this there is a taxation on a company, firm, or LLP under section 56(2)(7)(a), wherein shares of unlisted shares are received without consideration, and aggregate fair market value of such shares received during the previous year exceeds rupees 50,000. Or alternately, if the shares are received for consideration which is less than FMV, an aggregate of differences of all shares exceeds 50,000, then such difference is taxable as income from other sources. So in the section clause 28 of Form 3CD envisages that the auditor should report it under that clause for the 56(2)(7)(a). Similarly, we have one more clause, 29 of the Form 3CD, which says that share premium received by closely held companies in excess of the fair market value. Again, in the taxability is under clause 56(2), subclause 7B. So in that case also under clause 29, we have to report 56(2)(7B) cases. So that are the two clauses which I see under 56(2), where we have to report in the Form 3CD. Thank you.
Okay, thank you, Sachin sir. Atul sir, the question is related to you. The first question which we asked to you regarding the loan and deposits which are repayable on demand. So similar to that, one audience has asked the question that loan provided by the director and which is repayable on demand. So
yeah, that's that. I think I had already.
That was the first question, and that the similar question has come, and the only change is the loan is been received from the director.
Yeah.
So is there any change in that?
Yeah, I think company and directors are not the same. They are distinct persons, and a loan, when it is repayable on demand, it doesn't have time bound limit. So as per the, if you take the section para 56.7 of guidance note, it has been clarified that when it is not it is repayable on demand and doesn't have covered in the loan or deposit, it will not to be reported.
Okay, thank you, sir. The next question is for professionals, if they are not covered under the section 44 AD, and also no tax audit is applicable to them as they're under the limit. So whether on the basis of books of accounts we can show profit below 50%?
Unfortunately not. That is not, that liberty is available in 44 AD, but it isn't available in 44 ADA.
Okay. Right, thank you, sir. The next question is tax paid on buyback of shares by company under section 115QA is disallowed under which clause?
That need to be checked. That is to be buyback on tax paid on buyback. Any tax, but I think section 40 talks about any tax paid, some duty paid is not allowed as a deduction.
Okay, any other speakers which might can answer?
If I'm not mistaken. Yeah.
Okay, we'll revert on this question later. There's one more question. Any speakers can answer this. Cash introduced by proprietary in his capital account, whether it is to be reported in 3CD?
Yes.
Yes, Prakash sir.
269 ST, that
Yes.
says that any amount received more than 2 lakhs from a person in a single day on a single occasion is to be reported. If the amount is received by the partnership from more than 2 lakhs at single point of time, that needs to be reported in clause 31.
Sir, I would beg to differ. The question asked is about proprietor. Now, in case of proprietor, the firm and the proprietor one and the same. So there, I think there is no concept of cash introduced because one cannot take cash from himself. So this is a misnomer. How can a person take a cash from himself?
I'm talking about
Yeah.
the ownership firm.
Yeah. No, it's all right. So I think this actually it is not practically possible for a proprietor to take cash from himself. So that will not be allowed. And
he's maintaining two set of books.
Exactly.
But still, the cash book should be one and the same. Right? It cannot be that
I
cash
concur
of.
with Bansalji. I concur with the Bansalji because you cannot give to yourself. So when it's a
That is what I want to say.
you can't have, because there is no change of hand. There has to be change of hand.
Yes.
Okay, there's one more question. What would be our approach while reporting under the clause 34A of Form 3CD? So,
What approach you are talking about?
it is
Clause-
only about the clause 34A, and if you can elaborate on this particular topic.
34A.
Clause 34A talks about the it requires furnishing of certain details regarding the amount of payment of which tax was required to be deducted and whether the same has been deducted or deposited to the credit of central government. See, in this particular case, reporting requirement is you need to deduct tax. The person who is under audit needs to deduct tax on certain amount and certain sections are applicable to him. The tax auditor needs to go by the books of accounts and profit and loss account balance sheet and to find out whether the provisions of TDS, TCS are applicable to certain amounts. And in that particular case, after receiving this information, whether the tax so deducted, if it has been paid or remain to be unpaid, that needs to be required under clause 34A. A table has been provided in Form 3CD itself, which is elaborative, and the person, the auditor, may act accordingly. He might go by the table and provide the information. Thank you.
Okay, thank you, Manoj sir. Actually, yes, these are the questions which I have received from the.
We were talking about 115 QA, so I just studied that. So
Okay.
it seems that the rate of tax is mentioned in the section itself. As far as the shareholder is concerned, any amount received by the shareholder on buyback of shares is exempt from tax. It is not taxable. But the company per se has to pay the tax at the rate of 20% plus applicable surcharge and education cess. So the rate of 20% is mentioned in 115 QA itself. So the taxability is as per that section, and the rate of tax is 20% plus surcharge and education cess.
The same will be disallowed under section 40, subclause 2.
Yeah, but shareholder is exempt under section 1034A.
Exempt and company is liable to pay tax, but under which section it was disallowed? That was the question, I think so. That was disallowed under section 40, subsection 2.
Okay. Okay.
Right. There's one more basic question has come from audience, that if the turnover is less than 1 crore and he does not want to opt for the presumptive taxation, so whether he can show the profit lower than the 6% and 8%?
This amendment has came in section in 2016, I think so. It says if he has opted out, then there is a restriction. If he has not opted out, then there is no restriction. He can continue with the existing system. That is my view.
And he can show below 6 and 8%, right? Yes.
So he has to, we have to consider 44 AD subclause 4, wherein for 5 years he cannot change opt-in and
That is
opt-out.
possible when he has opted out.
Yes.
Exactly. He is not opted.
He has not opted.
If he has not opted out, then there is no need for a tax audit in a particular AD.
Yeah. So we have to consider 44 AD4 in this case.
That is from 2016 onwards.
Yes.
Then this amendment came.
Okay. Right. Thank you, everyone. I hope the questions are now over. If any speaker wants to, share some knowledge which you feel that has not been shared in our discussion, so you are free to speak.
something under which section we are auditing the books of accounts. That's an interesting issue, I think. So. We are writing section 40A in case the turnover exceeds more than 1 crore. Then there are another 7 clauses, 40A, 40B, 40C, 40DE. My question is, there are other 2 provisions in the drop-down box when we go to fill the tax audit form. Third proviso, and other is when your turnover exceeds 1 crore to 10 crores. If it is your turnover is less than 10 crores and you have 5%, more than 5% cash receipts and more than 5% cash payments, whether we can use under which section you are auditing the books of accounts. Whether if your turnover is 6 crores, I assume, and your payments are more than 5 crores in cash, then under which section we are supposed to report. That is 40A1 is also applicable. And we have another clause which says that audit is being carried under last column. That is your turnover is less than 10 crores and your cash receipts and payments are more than 5% of the total turnover, total receipts and payments. So whether we can report 2 sections at a time in this scenario, or we can report only the last part, that is the audit has been carried out in case turnover is less than 10 crores. So in my opinion, we are writing that 40A clause is applicable when the turnover exceeds more than 1 crore. If the turnover is less than 10 crores and the payments are exceeding 5 crore, 5% of the receipt or 5% of the payment as the case may be, we should write the last part of it. Not only 40A, 44ABA we report, we have to report the last part. And whether we can report 2 sections also, that is also possible in the drop-down box. We can report 2 sections. That is, if the turnover, that is under third proviso, if the books of accounts are audited under any other section, that also can be reported, and 40A can be also reported, or 40 last part is 6th part, that can also be reported. This is my personal view. That has not been given anywhere else. Any report from the participants? Any comments from the participant under this clause?
But I think proviso is a separate thing. No, it is not a clause. So when they are specifically
there is
asking
a
for clause,
there is a drop-down box which says that under which section you are auditing, under which proviso.
Yeah, section or clause.
Proviso. This is the first proviso of section 44AB.
Proviso is a proviso. It is not a clause. So maybe that
when
is
we are writing that under any other audit has been carried out under any other act, we are writing as carried out under the third proviso. This is a drop-down box specifically we are mentioning. Here also we should mention that it is being carried out, but since the turnover has exceeded 1 crore and it is less than 10 crores, then we should use last drop-down box for audit under which it has been carried out.
we can do that.
It's an addition.
Yes, thank you. I hope all our audience, has enjoyed this session, have gained some extra information from all our panelists, and I hope even our speakers have found it very well going session. So thank you, everyone. I think there are no questions, so we can end this session here as we have finished this in time. So we can end the session. And before ending the session, I would like to thank all the team members. I just received a message from team that there were 2,328 participants were there for this session. And I highly appreciate that count. And thank you all the audience for, listening us very patiently. I hope you have all enjoyed it. And you again the very good knowledge from this session. So now, thanks to all the team members of TAQRB team. Thank you to the chairman, sir, CA Raj Chawla, sir, and CA Chandrasekhar Chitle, sir, for organizing this session. Thanks to all the speakers who have given their precious time for this session and for enlightening us with their knowledge. Thank you, CA Sachin sir, CA Jayaprakash sir, CA Manor sir, and CA Atul sir. Thank you, everyone. Thank you so much.
Thank
We
you
are
very
also
much.
thankful to you
Thank you very much. Thank you.
Thank you, sir.
for
Thank you
moderating
all.
the session
Thank you
nicely.
for, yeah, thank you,
Yes,
Pritesh,
thank
for
you.
Thank you,
moderating.
Pritesh.
Pritesh bhai, thank you very
And
much
thank
for
you,
moderating
the
session.
You have
tech
moderated
team
very
and
Thank you,
nicely.
one
all
and all.
behind.
Yes, thank
Thank
you. Thank you, everyone. Okay.